When you look at the national commercial real estate landscape right now, it feels kind of like watching a slow motion disaster movie.
Oh, absolutely. I mean, it's a profound structural shift.
Right, because you pull up the data on the national office market, and
Yeah.
we are talking about a historic crisis. Like, vacancy is hitting 19% across the board.
Yeah, and if you zoom in on coastal tech hubs, places like San Francisco or Seattle, it is incredibly grim.
Oh, it's
We're
brutal.
talking 30 to 35% of office space just sitting completely empty, basically collecting dust. Entire city centers are trying to figure out how to survive when the daily commuter population simply vanishes.
Vanishes and just doesn't come back, which honestly makes the data we are looking at today so incredibly jarring.
Yeah, it's a total contrast.
Because you flip the page from those national numbers and you look at the inland Northwest, specifically Spokane, Washington, and you see an office vacancy rate sitting at a highly resilient 7.6%.
Which is just wild to think about.
Right. 7.6% against a national average of 19. I mean, it is less than half the national average. So the immediate question for you listening is, well, what does Spokane know that the rest of the country doesn't?
Exactly.
What is structurally insulating this specific market from a nationwide collapse?
And that is really the defining question for investors right now. It's a fascinating case study in how local microeconomies can just completely buck these massive national macro trends.
And answering that question is our mission for this deep dive. So today, we are completely ripping apart the Q1 2026 data to unpack what makes the office markets in Spokane and Coeur d'Alene, and that's pronounced Coeur d'Alene for anyone who might be new to the region.
Good clarification.
Yeah, you got to get that right. But we're looking at what makes Spokane and the CDA market so uniquely bulletproof right now.
And we have a really deep stack of premium sources to build this picture for you. We're pulling from CoStar, Crexi, the Spokane County Assessor's Office, and some highly detailed internal data as well.
Right. And crucially, this specific research brief was prepared by Eric Peterson at ACTIV8 Real Estate.
Yeah, highly recommend looking at his work.
For sure. If you are a property owner or an investor listening to this right now, you are definitely going to want to have his number handy. You can reach Eric directly at 509-903-9077. I'll give that to you again at the end, but for now, let's just establish the baseline.
That's good.
Give us the quarter in a minute. What are the rapid-fire 60-second headline numbers from the data that we need to understand?
Okay, so let's run through them. First, the 12-month sales volume is historically muted. I mean, we were looking at approximately $65 million transacted.
Wow, 65 million.
Yeah, it's low. Second, as you just highlighted, market vacancy is incredibly tight at 7.6%.
Right.
Third, and this is interesting, the 12-month net absorption is actually negative 10,000 square feet.
Right, hold on. I want to pause on that third metric because it feels like a total contradiction. Negative 10,000 square feet of net absorption.
Yeah, it does sound off at first glance.
Because for the listener who, might not live in commercial real estate jargon every day, net absorption just means the total amount of space leased minus the total amount of space vacated. So if that number is negative...
It literally means more tenants are packing up and leaving than moving in.
Right. So how does that work with the vacancy rate? What's the final cap rate metric?
Well, the fourth point is that transacted cap rates are averaging 7.1%. So to summarize the entire quarter in one line, Spokane's office market is technically losing occupied space, but ironclad supply discipline is keeping pricing and vacancy totally stable.
Okay, well, let's unpack this contradiction because we've got a fantastic vacancy rate of 7.6%, but actual transaction volume is practically frozen at just $65 million.
Yeah, the market is crawling.
If the market is so incredibly healthy and stable, why is nobody buying these buildings?
Right. So to understand that freeze, we really have to pull the lens back and look at the macro environment. Specifically, we have to look at the Federal Reserve.
Ah, right. It always comes back to the Fed.
Always. In their March 2026 meeting, the Fed decided to hold the benchmark rate steady at 3.50 to 3.75%.
And that wasn't a unanimous hold either. I mean, that was an 11-to-1 vote, with Governor Miron being the lone dissenter pushing for a rate cut. The rest of the committee is essentially locking the brakes.
Exactly, because inflation is proving to be incredibly sticky right now. I mean, it's hovering around 2.8%.
Right.
And then you add to that the geopolitical uncertainty in the Middle East, specifically regarding Iran, which, threatens to spike energy prices and drive inflation right back up. The Fed just cannot afford to cut rates prematurely.
But let's connect those dots for the listener because the Fed controls short-term borrowing, right?
Correct.
So if I'm an investor trying to buy, say, a $10 million office building in Spokane, why do I care so much about what the Fed is doing with short-term rates? Doesn't commercial real estate rely on long-term debt?
It does. But that brings us to what we call an inverted easing dynamic. You're totally right that commercial real estate loans are generally priced against the 10-year Treasury yield.
Which is like the global benchmark for risk-free long-term money.
Exactly. Now, short-term rates actually drifted down slightly in late 2025 because people anticipated Fed cuts. But the 10-year Treasury remains stubbornly elevated at 4.31%.
Wow. Meaning the cost of the actual money you need to buy a building is still just punishingly high, regardless of the Fed tweaking the short-term dials.
Yeah, and lenders are reacting to that risk by really tightening the screws. I mean,
Okay.
for anyone out there trying to get a commercial loan right now, the conditions are just brutal.
How brutal are we talking?
Well, credit spreads, which is the premium the bank charges you on top of that Treasury rate, they're hovering around 75 to 80 basis points.
And just a reminder, a basis point is 1/100%.
Right, so that's an extra 0.75% tacked onto an already high rate, just for the privilege of borrowing.
And I was reading through the underwriting standards in the brief, and the DSCR requirements are just wild. Lenders are demanding a debt service coverage ratio of 1.20 to 1.25 times.
Yeah, they are not messing around.
To translate that, for every dollar of mortgage debt you owe the bank, the building's current rents have to generate $1.25 of net operating income. I mean, there's zero margin for error there.
Absolutely zero.
Mm-hmm.
And they are only underwriting based on current net effective rents. So if you go to a bank and say, I'm going to buy this half-empty building, renovate the lobby, and lease it up at a premium in 3 years,
They'll just laugh you out of the room.
they will politely show you the door.
Yeah.
They do not care about your optimistic projections. They want cash in hand today.
Which completely explains the radical shift in who is actually buying. Because national capital is expensive, and national lenders are frankly terrified of the office sector right now.
Terrified is a good word for it.
So the buyer pool has shrunk way down to the local level. The data shows a massive 88% of buyers over the past year in Spokane are local. Only 12% are national.
Right, because national institutional money is basically sitting on the sidelines waiting for the dust to settle on valuations. But local money, the family offices, the investors who know the neighborhood block by block, who have 20-year relationships with local community bank presidents.
Yeah, those personal connections.
Exactly. Those are the only entities capable of executing deals in this environment.
Okay, so if nobody is really buying and tenants are technically leaving, going back to that negative 10,000 square feet of absorption, why aren't these buildings empty?
That is the big question.
Right. This brings us to the first major trend in the data: supply discipline versus demand softness. Like, how do we hold a 7.6% vacancy rate when the math says we are losing ground?
Well, the answer lies entirely on the supply side of the ledger. Because over the past 12 months, the Spokane market only delivered about 18,000 square feet of new office space.
18,000 square feet. That's nothing. That's what, a single floor of a medium-sized corporate building?
Pretty much. It is statistically zero when you consider that Spokane's total office inventory is approximately 24.2 million square feet.
Wow.
And here's the truly vital metric. That 24 million square foot total is barely larger than it was 10 years ago.
Wait, really? In a whole decade?
Yeah. Through active conversions of older buildings and outright demolitions, the market has kept an incredibly tight lid on supply.
So it's like winning a game of musical chairs. Not because you're the fastest, but because nobody has added a new chair to the room in a decade. If you don't build excess space, you don't have empty space.
That is a perfect analogy, and you can contrast that with peer markets across the West. Like Boise experienced explosive population growth over the last few years.
Oh, yeah, massive growth.
And developers responded by throwing up speculative office buildings, shiny new towers, built with the hope that tenants would materialize. But now, growth is cooled, and Boise is dealing with a massive hangover of oversupply.
And Seattle and Portland did the exact same thing, just at a much larger scale. They overbuilt to feed the tech sector, and then, the tech sector sent everyone home to work from their laptops. And now they are basically drowning in 25% vacancy.
Which segues perfectly into the second major trend, insulating the inland Northwest. The healthcare and education shield, versus the national return to office stalling.
Yeah, let's look at that national data first, because the great return to the office is looking more like a slow crawl at this point.
A very slow crawl.
52% of remote-capable employees nationwide are still working hybrid schedules, and 61% of companies have formally enforced return-to-office policies, but, employees are largely just ignoring them.
Right, and many of those companies quietly downsized their real estate footprints during the pandemic anyway.
So they wouldn't even have space if everyone showed up.
Exactly. Even if their entire workforce showed up on a Tuesday, they wouldn't have enough physical desks for them. So the national office market is desperately waiting for a return-to-office recovery that may frankly never actually arrive.
But Spokane doesn't need a recovery because they rely on industries where remote work is, well, physically impossible.
Precisely.
When you look at the biggest tenants in this market, you've got Providence, Multicare, Washington State University, government agencies. These are institutions that never left the office in the first place. You can't, perform an emergency room triage via Zoom.
No, you definitely cannot.
You can't run a university biochemistry lab from your living room sofa.
Right. Their daily operations are structurally fundamentally tied to physical real estate, and that gives Spokane an incredibly robust floor. The tech sector's volatility simply doesn't apply when your anchor tenants are hospitals and universities.
It's an incredible shield. However, shields only protect you from specific types of attacks. Which brings us to the third trend: economic headwinds versus tailwinds. Because the data shows that the local economy itself is actually quite sluggish.
Yeah, it's definitely facing some challenges.
Job growth in the area is basically flat, hovering between 0 and 0.5%.
And that mirrors the broader state of Washington, which is unfortunately experiencing its weakest job growth in years. On top of that, Washington state's minimum wage is now the highest in the nation at $17.13 an hour.
Which is great for workers, but tough on overhead.
Exactly. It puts immense operating cost pressure on the businesses leasing these buildings, particularly the service-adjacent companies that support those larger medical and educational hubs.
Now, you mentioned the medical hubs being a shield, but the research brief points out they are also the biggest economic watch item on the board right now.
This is the critical tension for the region. The primary downside risk is looming federal Medicaid cuts. If those reductions are enacted, it would just send a shockwave through Spokane's hospital-centric employment base. Because when your dominant economic driver is healthcare, any shift in federal reimbursement policy instantly becomes a local vulnerability.
Right, because a cut in federal funding could force hiring freezes or even layoffs, which immediately reduces the demand for medical office space.
Exactly. It's a direct pipeline.
But, we also have to look at the upside.
Yeah.
And just to lay out the impartial reality of the political funding here, regardless of anyone's leanings, the Spokane Aerospace Tech Hub is a massive potential tailwind.
Huge potential there.
Yeah, this initiative was initially awarded funding under the Biden administration. It was rescinded by the Trump administration. And now, here in March 2026, it has just been renewed by the Senate.
And the implications of that renewed federal support are massive. We're talking about backing for approximately 50 advanced manufacturing companies.
Wow, 50?
Yeah. And if that capital is deployed effectively, we are going to see a huge surge in demands for research and development space, flex industrial, and small office products.
Particularly out in the West Plains corridors and the University District. I mean, it's exactly the kind of economic diversification the region needs to offset the reliance on healthcare.
Completely agree.
Okay, so let's shift gears a bit. We've established that supply is incredibly tight, the tenants are fundamentally in person, but lending is terrible.
Right.
So let's look at the actual transactions getting done. Who is braving this market? Because the transactions roundup in the data tells a really highly specific story.
It does. We can look at two major closed deals that really define the current environment. First, Washington State University purchased a medical office building in the University District for approximately $8 million, which breaks down to roughly $210 per square foot.
And the second major deal is the Spokane School District buying River Point 1 from the Spokane Community Colleges for approximately $12 million.
And in that case, the school district ran the numbers and basically realized it was significantly cheaper to buy an existing structure than to navigate the costs of building a new one from scratch.
Wait, let's connect these two deals because Washington State University and the Spokane School District, neither of those entities are real estate investors.
Right.
They aren't buying these buildings to lease them out and collect a yield. They are end users buying their own offices. So if I'm an out-of-town investor looking at that headline, 7.1% cap rate we mentioned earlier, I mean, that data is basically contaminated, isn't it?
Contaminated is the perfect word. The report accurately states an average transacted capitalization rate of 7.1%. Now, for context, a cap rate is simply a building's net operating income divided by its purchase price, right? It's the annual return you expect on your investment.
Right.
But the owner-user illusion is heavily distorting that average.
Because owner-users don't care about cap rates.
They don't factor into the equation at all. An owner-user buys a building because they just need a roof over their employees' heads.
Makes sense.
They might gladly pay a premium over market value because the location is directly adjacent to their existing campus, or because buying saves them from a 2-year construction headache.
Oh, I see. It's like the difference between buying a car because you need to drive it to work versus buying a car to rent it out on Turo to make a profit. The math you use to justify the purchase price is entirely different.
That's exactly it. Which means if you are a traditional investor underwriting the purchase of a Class B office building right now, you must be highly cautious.
Yeah.
Do not use owner-user transaction prices to justify what you should pay for an investment-grade asset next quarter. The underlying logic just does not translate. An investor needs cash flow, an owner-user just needs space.
That is a phenomenal warning for anyone actively trying to price a deal in this market right now. Now, before we look at the forward watch items for the office sector, the research brief actually included some fascinating internal data on the multifamily space.
It did, yeah.
And I know this is an office deep dive, but the housing market impacts everything. What is happening on the residential side?
So the internal data reveals a sharp discrepancy that ultimately reinforces the office narrative. Single-family home permits in Spokane County dropped drastically to just about 145 in 2025.
That's incredibly low.
Right. And with single-family housing supply that constrained, developers are shifting their capital heavily toward multifamily projects.
And the financing environment is actually supporting that shift, isn't it? The brief mentioned agency multifamily lending caps increased.
They did, by roughly 20% year over year.
Wow.
Yeah, and agency caps refer to the lending limits set by government-sponsored entities like Fannie Mae and Freddie Mac. So when those caps go up, it means there's more federal liquidity available for apartment developers.
Got it.
So while capital is fleeing the office sector, it is actively flowing into multifamily. Developers are just going where the money is cheapest and the demand is clearest.
It's all an interconnected ecosystem. I mean, if a developer is busy building apartments because that's where Fannie Mae is lending, they certainly aren't going to secure a terrible loan to build a speculative office tower that literally nobody asked for.
Exactly the point. The multifamily boom actively enforces that office supply discipline we discussed earlier.
All right, let's bring this home. We've dissected Q1. What does this all mean as we look ahead? What are the big red flags or green lights property owners should be watching for in Q2 2026?
So there are two critical forward watch items supported by the data. First, we really need to monitor the older Class B and Class C office buildings.
Okay.
Because while the overall market vacancy is incredibly low, we are seeing a continuous flight to quality.
Mm-hmm.
Companies are taking advantage of stagnant rents to upgrade into nicer Class A spaces.
Leaving the older, unrenovated buildings behind.
Exactly. And the question is, will rising vacancy in that older product eventually crack the pricing of the broader market? Like, if the Class B building across the street is sitting half empty and the owner starts slashing rents just to survive, can the Class A building realistically hold its premium value?
It's the classic race to the bottom.
Right.
And the second watch item.
The narrowing cap rate spread. Historically, Spokane has enjoyed a healthy yield advantage over coastal markets, to compensate for being a smaller secondary market. Right now, the Spokane market model shows cap rates floating around 10.2%.
But CoStar's national model shows U.S. office cap rates stabilizing at roughly 9%.
Exactly. And as that national number rises and stabilizes, the historical advantage of buying in Spokane shrinks.
That makes sense.
If a national institutional buyer can finally get a clear, safe 9% yield in a major market like Dallas or Seattle, they're going to be far less incentivized to chase a 10.2% yield in Eastern Washington. Local money might remain dominant simply because national money loses interest.
Which leaves us with a truly provocative thought to close on. Because we've established that Spokane's greatest strength is its reliance on huge, structural, in-person institutions, hospitals, universities, and schools. They are the ultimate moat against the work-from-home revolution.
A moat that has completely insulated the market from the primary contagion destroying coastal real estate.
But let's connect that back to the multifamily data we just touched on. Single-family home building has basically stopped. Rents and housing prices are climbing.
Right.
So if the nurses, the lab technicians, and the teachers who staff those massive in-person institutions can no longer afford to live in Spokane County, what happens?
That is the million-dollar question.
If the workforce is priced out of the region, those hospitals and universities can't staff their facilities. They stop expanding. The very institutions propping up the office market could begin hollowing out from the bottom up, not because of remote work, but because of a basic cost of living labor crisis.
That is a phenomenal macro-level risk to consider. The stability of commercial real estate is ultimately tethered to the availability and affordability of the local workforce. I mean, you can't lease medical space if you don't have medical workers living in the zip code.
Yeah, it just proves you cannot look at commercial real estate in a vacuum. Everything from the 10-year treasury to single-family housing permits plays a role in the value of an office building.
Absolutely.
Well, that is our deep dive on the Q1 2026 Spokane and the CDA market. We covered a massive amount of technical ground today. If you are a property owner or an investor trying to navigate this inverted lending environment, or if you just need to know how these trends impact the specific valuation of your portfolio, you need an expert in your corner.
You really do.
For a custom market breakdown, contact Eric Peterson at ACTIV8 Real Estate. You can reach him directly at 509-903-9077. Again, that is 509-903-9077.